Shankar Raman, CFO at L&T, talking about it. Let's listen.
Details of the segment, and possibly in the course of the presentation we will cover some aspects of the outlook as well. The company has performed very well during the quarter ended 30th June 2018, and the strength of the performance is borne out by the fact that across various parameters the company has done very well and exceeded the previous year's first quarter numbers handsomely. The order inflow has grown by 37% as compared to the previous year's first quarter. Because of the 19% increase in revenues, there is also a moderation in the order book growth by about 3%. But that's fine considering the fact that the momentum for picking up orders and executing underlies the movement of these numbers. The most satisfying part of this is the ability to work profitably, and the profitability has improved in terms of EBITDA margins by about 160 basis points, which translates to a 40% growth in EBITDA year on year for the first quarter. Consequently, the profit after tax moves up smartly by 36% as compared to the previous year's first quarter. Looking at the results in some detail, let me start with the order inflow, which is where all of that exercise for the company's performance begin. During the quarter ended 30th June 2018, we have secured orders worth 361 billion rupees, and the 361 billion rupees is a 37% growth over the 264 billion rupees that we won during quarter one of the previous year. If you look at the 361 billion rupees, we find that nearly 74% of 361 billion rupees is from domestic orders, and the international orders at 94 billion rupees represents a 26% share. Insofar as domestic orders are concerned, we saw 45% growth as compared to the quarter one of the previous year. 185 billion rupees was the orders that we picked up from domestic markets in Q1 of the previous year, and in Q1 of the current year we picked up 267 billion rupees. And much contrary to the expectation that the international order inflow would slow down consequent to the geopolitical crisis, plus the tweets and retweets and the oil prices, we found that the international orders actually improved during the year-on-year period from 79 billion rupees to 94 billion rupees, which is a growth of 19% over the first quarter of the previous year. If you reflect on the order inflow, what we find is a fairly strong tendering activity, which means that the sponsors of these projects are beginning to look at opportunities to put capital to work, to create infrastructure and capital assets. And that's good news, because I think it's very important for both the industry and the company to ensure that there is robust growth in the order inflow backed up by the investment momentum. We also found, as I mentioned just a little while ago, the international opportunities are beginning to improve as compared to the softness that we saw exactly a year before. Much of this activity is triggered by the government programs on developing the country's infrastructure, and hence a combination of government programs sponsored by either the PSU's own cash flows or the multilateral funding agencies supporting the programs. These have been the main reasons why public order, I call it public order, it's government stroke PSU stroke government programs, both state and central, they have moved forward on this basis. Private sector, we find that in pockets investments are happening. They are in obviously sectors where a lot of consumption is seen, like the automobile or construction, mining equipment. But in the metal space, with which the company is intimately connected, much of the investment currently happening are to pick up the stressed assets that are available, So consequently, we find that the investment, either brownfield or greenfield, directly into sectors is not as strong as it once used to be. But I guess private sector by and large is on wait and watch mode, and would possibly make the moves once the environment is conclusively favoring economic activity for their respective businesses. The infrastructure has been the main lever for growth of orders, and we saw this momentum turn in October last year, and we had 2 quarters of the previous year finishing on a fairly strong note, and we were anticipating that this momentum could continue. This being actually a year that is a run-up to the union elections, it was important for the government to get on their scorecards projects which are worthy of being showcased when they seek public mandate. Leave aside the political intentions. I think the fact that India lags in its infrastructure and it needs to compete with the world, which is getting increasingly protectionist in its approach, it's important that we develop competitive infrastructure, and that means good news for companies like L&T, which are well positioned to provide that. So consequently, the order book is at 2.7 trillion rupees, which is fairly robust and provides considerable clarity to the company's revenue streams over the next couple of years. As I mentioned, bulk of this 361 billion rupees came from infrastructure. 54% of the flow was from infrastructure. Hydrocarbon joined the party this year. 13% of the orders came in from hydrocarbon sector. And not to be forgotten, the services business, where we, for statistical reasons, count revenues as orders, because the revenues flow from orders that are contracted out, grew by has a share of 21%. And all the 3 wings of the services business, the information technology, the technology services, and financial services, have turned in stellar performance, and that has helped the group report a healthy increase in the order flow. The order book, which is 2.7 trillion, consists almost 2 trillion, 2.1 trillion actually, of orders in the infrastructure space. So bulk of our revenues for the next couple of years is going to flow out of this pie, followed by hydrocarbon, which has 284 billion rupees, and also followed by the rest in their respective proportion. Getting on to the details of the revenues and profits. Revenues first. The company's revenue at 283 billion rupees is up 19% as compared to the Q1 of the previous year. 34% of these revenues come from international contracts. Since we have a fairly large portion, almost 24% of our order book in international contracts, the revenue flows from international contracts as we execute them comes through strongly in the earnings statement. The manufacturing and construction and operating expenses have benefited both by the leverage that the increased volume has provided, as well as the operational excellence program that the company is embarked on across all its business verticals. So consequently, on the back of a 19% revenue growth, we find that the operating expenses have grown by 13%, leading to a headroom for profitability improvement. The finance charge meant for financial services business is part of the manufacturing, construction, operating expenses in a manner of speaking, because money is the raw material for that business. So when we consolidate the interest charges that are paid by the financial services business are treated as part of our input costs. The staff costs are up by 21% from 35 billion rupees to 43 billion rupees. This is largely on account of the staff augmentation and resource augmentation that we have done to create greater capacity in the services business, particularly the information technology and the technology services business. Selling administration cost at 22 billion rupees is up 30%, and these represent the cost provisions that we have made for expected credit losses, as well as the business development expenditure that has been incurred. We do believe some of these expenditure will have their fruits coming through in the subsequent quarters. EBITDA at 29 billion rupees is up 40%, and we have finance cost at 4 billion rupees. This is stable across the year's period, which is good news in terms of finance management. This is being achieved in an environment where interest costs are going up. So it's creditable that the company is able to rein in the interest cost at a time when volumes of business is going up. Depreciation is at 6 billion rupees, and other income at 2 billion rupees is lower as compared to the 4 billion of the previous year, largely reflecting the lower treasury earnings and also the volatility that was introduced into the markets due to the cyclicality of the interest rates. Tax expenses at 9 billion rupees and share of profits from JVs and subsidiary associate companies at 3 billion rupees, adjusted for the minority interest, leaves the company with a profit after tax meant for the equity holders at 12 billion rupees. A 36% growth over the 9 billion of the previous year. In terms of segment performance, there has been one change that the company has made, in fact, two changes. One was the metallurgical and material handling business, which is part of the other segment, has been included as part of infrastructure segment, largely because of the internal restructuring that we have done, bringing that segment under the common leadership of infrastructure. So accordingly, they have been reclassified. Commencing from this year's first quarter, you will find infrastructure segment to include MMH. The other change that we have made is heavy engineering, which included both the process plants and nuclear plants, along with defense engineering, has been bifurcated into defense engineering and heavy engineering. And heavy engineering retains the process plant and nuclear power plant equipments, whereas the defense engineering includes the systems and services that we provide for the defense aerospace sector. The shipyard that we have down south is largely dedicated for the naval application. So consequently, the shipyard has been christened as part of the defense business and clubbed along with the defense segment. So we're going to have the announcements with an additional segment in terms of defense engineering, but to possibly many analysts and commentators' relief, the other segment will get less crowded and a little more easily discernible. Let me start with each of the segments to tell you how it has performed. Infrastructure is the biggest segment, so we start with the infrastructure segment. The segment recorded a revenue of 121 billion rupees, and that's almost close to 10% growth over the previous year. It's not so much about the percentage there, but it is important to note that such a large segment moving at a 10% growth speed is actually good news and augurs well for the company's revenue overall. Out of the 121 billion rupees, we have 37 billion rupees coming in from international projects. As you know, in the past, we have spoken about the orders that we have won in infrastructure space in overseas markets like Middle East, Sri Lanka and elsewhere. And execution of those projects have actually led to the share of 37.5 billion rupees. The EBITDA margins have moved on from 7.1 to 6.8, but this is largely reflecting the stage of execution, and we have actually repeated ad nauseum in this forum that the quarterly margins are not representative of the whole year's margin position. They move according to the dynamics of the job mix and when the jobs reach a milestone stage where margins get recognized. So considering the mix that we have for the quarter ended 30th June 2018, the margins are at 6.8%. But we are very confident by the end of the year, the margins will get back to growth trajectory. The next segment is power segment. It's a segment which is having a lot of sectorial headwinds. We have spoken about this earlier. The opportunities are very limited for thermal, and we specialize a lot on thermal power plant creation in terms of EPC contracts. And we also do a bit of solar, but generally as a segment, there are a lot of moving parts, and consequently the aggressive competition that goes after the limited opportunities does make this segment's performance a fairly stiff challenge. But having said that, given that we are a very leading EPC player, we are trying to figure out models and opportunities to ensure that we have meaningful role in the opportunities, whatever they be in this segment. We've also stepped outside of the country We've been doing 3 projects in Bangladesh rather successfully, indicating that the competencies that we have in this segment can be put to global application and need not be restricted to India. We do find that on the back of these orders that we have won outside of India, we've been able to increase the contribution of the revenues from international orders, and they are at 3.5 billion rupees as against the 10.8 billion rupees of the total segment revenue. The EBITDA margins have moved from 1.3 to 4.1% for a quarter. Neither percentages are representative of the true margin potential of this business. And like any other project business, they reflect the cost booking and the revenue and the margin recognition at a given point in time. Even though the segment does oversee the business of boiler and turbine manufacturing, because these are jointly controlled units along with our partners, Mitsubishi Heavy, the financial statements recognize neither revenue nor any of the cost items. It's only the profit or loss of these JVs are added as a line item. So consequently, the EBITDA margins of the power segment excludes the EBITDA margin of manufacturing activity, which generally, by definition, are healthier. Hydrocarbon segment has been a good turnaround story. It always was a good, profitable, dominant segment. We went through a very rough patch a few years ago, but to the credit of the organization, it has bounced back rather well, completed all those difficult projects. We incurred losses, but most importantly, we won the trust of the customer because we completed those projects and handed over them successfully. We do believe all of that legacy is behind us, and the results that you see are representative of the progress that we are making on the current set of orders, which I do believe are profitable. The net segment revenue from hydrocarbon at 35 billion rupees is up 38% as compared to 25 billion of the previous year's first quarter. Much of this revenue comes from international markets because half of our business anyway is international, and hydrocarbon by definition is an international business. So 18.4 billion does come out of international contracts execution. The EBITDA margins of this business is steadily increasing. From a situation where we were losing money on projects to a situation where we are up 7% to the current quarter does show the trajectory. We do believe that the best for this segment is yet to come. The heavy engineering segment that I spoke to you about has got bifurcated as mentioned. So just talking about the process plants as well as the nuclear plant, specialized custom built equipments for oil and gas refinery sector, etc. The segment has done very well in the quarter. The numbers are far modest as compared to infrastructure sector, but that is understandable. Given the fact that it is a very niche business and high-tech involves high-tech manufacturing, the segment has done well to have 3.3 billion rupees of revenue, which is a 29% growth over the 2.6 of the previous years.